Welcome to you. Great to see you. Holy smokes on the crypto front.
Good morning. Good morning.
We'll invite everyone to send their questions in over the next half hour or so for Jurrien Timmer. Jurrien, what do you make of this? A lot of it you had unpacked a couple of years ago into a crypto thesis. The scarcity was part of it. We've had this bull market coming after the recent US election results. We sort of know the story. Tell us how it fits into the market story and maybe pushes out other assets.
Yeah, so let's start actually with slide 23. So yeah, it was was it 2024? Yeah, it was 4 years ago that I first kind of really dug into the Bitcoin thesis, what makes it tick, and I came up at that point with this chart showing that we know what the supply story is, obviously, and that's part of the appeal that it is a fixed supply, 21 million coins. And we know that, and therefore that should be relatively priced in. But what we don't know is what the demand looks like. And so we used various historical growth curves, we call them S curves, to kind of gauge, so how long did it take for everyone to have a mobile phone or for everyone to have internet, et cetera. And so I came up with this chart, and over the 4 years, the price has actually followed. It kind of, zigs and zags, but it zigs and zags around like a pendulum around some central value, which is related to the demand curve. And then the light blue line on that chart, if you look closely enough, is just the power law curve of the number of addresses or wallets for Bitcoin. So it's following on the path, and if you kind of read the fine line on the scale, you can see it's sort of up and to the right, and that continues. So the evolution of the demand for Bitcoin obviously is I think the single biggest factor, and part of that story has to do with regulation, and that's why this has been a big story since the election. But part of it obviously has to do with central bank policy, real rates, and the money supply, and the growth of that. And in that sense, it's I think particularly interesting if we go to slide 22,
Money supply.
where
Wild.
yeah, where so when you look at M2, the real M2 money supply in the US, which is the line in the top, and you look at the ratio of gold's above ground value to M2, and then in the last 10, 15 years, I've added Bitcoin's value as well. You can see that during periods of monetary inflation, meaning the money supply is growing faster than its average. So the average growth rate of M2 is 6%, of real M2 is about 3%. So that's your inflation rate right there. So it grows over time, just like GDP grows, just like stock market grows. So that's fairly normal. So it should never really be a flat line, but it's a question of how steep the slope is. And when the slope rises like it did during the 30s and the 70s, and in recent years, gold generally catches up to that because it's a store of value. So it's a hedge against monetary inflation. So it will do better when there is monetary inflation. And then when you add Bitcoin, which to me is another player on the same team, it's like gold's precocious younger sibling or something like that. That I add that to the market value. So obviously, with gold having gone up quite a bit over the last few years, the above ground value of gold is now about 18 trillion, and Bitcoin is worth 2 trillion, right? 100,000 times 20 million coins is 2 trillion. And so Bitcoin and gold combined are now close, very close, like 98% of M2 in the US. And so the reason I mention all of this is because, people are fixated on 100,000. That is the price, right? Price and value are not the same thing. Same thing. Price is what you pay for something. Value is what you get. And there's going to be a whole lot of people who think 100,000 is way too high, that it should be zero. And then there's a whole bunch of people who think 100,000 is way too low. But those are just prices, right? So this is one attempt, along with those S curves I showed earlier, to get a sense of what is the fundamental value. And the S curves are indicative of that because that's demand. This is a network asset. As the network grows, the value should go up, even though Bitcoin doesn't produce the cash flow. And then this chart shows just that as a monetary asset, as a hedge against monetary inflation, during periods of robust monetary growth, gold and Bitcoin should approximate the value, which is what they're doing. So it's just a way to anchor the price in a valuation context.
So you've anchored it. I wonder if I can sort of blow it up and make it philosophical again for a second, because um, to the extent that we see a trend of more of an interest in real assets, I mean, depending on what that is, but there seems to be an appetite for real assets as well as equities and everything else. Crypto obviously is not a real asset because it's a digital asset, but is there some way that the two are kind of connected in this search for alternative assets, literally?
Yeah, I think so. So we know gold is a real asset. It has over 1,000 years of proven history. We know real estate is a real asset, and equities are a real asset as well. I mean, right, these are actual companies generating actual profits from actual products and services, and equities are a proven inflation hedge. They're not a hyperinflation hedge, but they're like a garden variety inflation hedge. And so that's where you have to look, and commodities obviously as well. But the commodity spectrum in general is a harder one to solve for because there's so many different parts, and oil, and you have oil and copper and this and that. And actually, if we go to slide 1, you can see the kind of the dichotomy here. Slide 1 shows the leaderboard year to date through November. And it's just interesting that
Look at that.
commodities are the only negative asset together with long-term bonds, which, you would think that if bonds go down, commodities would go up because inflation, but also commodities are the second worst and gold is the third best. So it just shows you that just like we say that the stock market is really just a market of stocks, the commodities market is really a market of commodities, and they don't always behave in the same way. But for crypto, again, I separate Bitcoin from all the other cryptos, right? So Ethereum, Solana, those are technological innovations. They're smart contracts. Bitcoin, I think, is trying to be money, and I think it's proving itself as money. Maybe not money that we use to buy stuff with, just like we don't use gold to buy stuff with, but it's a medium of exchange in theory. It's a unit of account, and it's a store of value. Those are the three characteristics of money. And I think Bitcoin is proving itself to be, again, another player on the store of value team. So that's how I sort of think about it.
I mean, looking at the leaderboard and also what you've said, there's a great deal of momentum that's been in the market. And earlier in the year, momentum, that term and that factor, was associated with great, big, huge companies traded publicly. And momentum has grown to mean a lot of other things towards the end of this year. But the discussion of momentum within the market surely deserves a conversation and some real advice from you. What have we seen here?
Yeah, absolutely. And if we go, and actually, before I answer that question, I just wanted to say one more thing on slide 2, just on gold. That it's amazing that gold is up more than the S&P 500, even though its correlation to the S&P is minus 53%. And it's, most people will not be able to see it on this chart, but the blue is negative correlations, the red is positive correlations. And so gold actually is one of the most negatively correlated assets to the S&P. And the S&P is up like 28% and gold is up 30%. So that's sort of a mind-bending hat trick to be able to do that. So gold is proven to be the ultimate diversifier.
Yeah.
Because Bitcoin has a positive correlation. It's up even more, but you would expect that when the market is up, that Bitcoin is up. But for the market to be up that much and gold to be up even more, even though it's negatively correlated, is quite a feat. But anyway, so to answer your question, to slide 3.
Mm-hmm.
So this has been a real momentum year, and I've showed this chart many times. And the easiest way to show that is that Earnings are up. They're up about 8%, 9% year to date. They're expected to be up 10% for the calendar year, which is, as we expected, as you would expect in year three of a bull market in a resilient economy. You would expect earnings growth to be positive. So there's nothing too dramatic there. But the PE side has contributed, like over 20 percentage points to that, right? The S&P is up 28, and most of that's come from the valuation side. And that shows that this is a momentum market. Usually the PE is inversely correlated from the E because the price is always anticipating the future. So the cycles kind of zig and zag, not at the same time. But during soft landing periods, you do tend to see that double-barreled, performance, and that's what we're seeing. And so, one big question, of course, is can we continue that next year? I have my doubts just because the PE levels are pretty high, the equity risk premium is pretty low, and the PE expansion has already produced a lot of gains this year, 20, 30%. So for that to do a repeat next year, I think is a high hurdle. But it shows that momentum is winning the day. And of course, as you mentioned, the Magnificent Seven are front and center. And we have some cool new charts to show on that front.
So let's dig into that, because this is the Mag 7. I guess one of the questions is, when did this all really start? Are we sort of going back to the 2022 lows and talking about the Mag 7 from there? And the earnings story, or because that was sort of a recession. Well, it was a recession, wasn't it? For them,
Yes.
certainly.
Yeah. The period of mega cap growth outperformance really started in 2014. So that trade is 10 years old, but it wasn't the AI trade. It wasn't the Mag 7. It was sort of the Nifty 50, and some of the stocks that are in the Mag 7 were obviously part of that, like, Meta and Apple and Amazon, but Nvidia wasn't really on the horizon back then. That's really more of an AI story. But if we go to slide 8, you see it's interesting. So that's a 10-year-old trade or trend. And that's part of the Nifty 50 work that we've talked about many, many times. But if you look at the market weight of the Magnificent Seven, it's about 30% of the S&P, and that's 7 stocks. And it's approaching kind of the levels where the tech telecom sectors were in 2000, where energy and materials were in 1980. So that obviously gives you pause about how much longer is there to go for this, because the ongoing strength of the Mag 7 plays into so many different directions for us as asset allocators and all the people watching, because that tells you about growth versus value, large versus small, US versus non-US, whether it's developed markets or emerging markets. And so there are many different iterations where this matters. And it even matters for the absolute direction of the market itself, because I'll show you slide 12 now, which shows that, and this is not the Mag 7, but the Nifty 50, the top 50 mega cap stocks. You can see on the left that in absolute terms, the mega cap stocks are perfectly correlated to the market, which makes sense, right? Because the markets are.
They are the market.
They are the market. The index generally that we think of are cap weighted. But if you look at the right side, which shows the relative performance of these top 50 versus the direction of the market, the bottom left quadrant in the orange there shows what happens when the Nifty 50s underperform and also go down in absolute terms. The market basically always goes down when that happens. And so, again, I'm not predicting this for 2025 at all, but it's worth keeping in mind that if this trade ever unwinds and reverses, it's probably going to be hard for the market to actually go up. And the irony would be that the market has broadened. We call it the bullish broadening all year. And the irony would be that if 7 stocks go down and 70% of the market goes up, the index will still go down. So you can be right about the economy, about all the stocks you're buying, but if you're buying it through some kind of index wrapper or an ETF or something that represents the whole market, you're not going to benefit from that, even though most of the stocks are actually doing what you think it would do. So again, not a prediction, but it's something we need to think about, that as this trend matures, at some point we might have to deal with how do you extract beta from the stock market without having to make these really big binary decisions about I'm going to short the Mag 7 and be long the other stuff. And so anyway, it's just something to think about. But for me, ultimately, so the valuation story, is known, right? The Mag 7 trade at, I think, 38 times earnings. The bottom 493 stocks trade at 22 times. So there's a significant valuation premium, but it's deserved, because if we go to slide 9, if you look at the Mag 7 and you look at the earnings estimates, they're soaring, right? So
That's a
these are
cool
the
chart.
yeah, these are the calendar year earnings estimates. And you ask anyone in this building where I am, they'll say price follows earnings. And the momentum in earnings revisions is very fertile ground for capturing alpha. So the companies, the stocks that see their earnings estimate rise tend to do very well. So if we now go to the next slide, that is the 493. And this looks more like the typical market, right? So the good news is that the calendar year from this year to next to the following, the numbers go up, right? So you have sequential growth of, 10, 12%, which is good. It's what you want to see. But the drift of the estimates tends to go down, which it always tends to do, right? And we've shown charts like that many, many times, where the estimates start too high and then they come sort of back down to earth. But as long as the growth is there, it's okay. So if we go now to the next slide, I want to just show you what I think is sort of the eye-popping contrast between the Mag 7 and the rest. So on the left is the performance. No surprise. The Mag 7 has really run away with this. But the right-hand side shows the earnings squiggles on the same logarithmic scale. And you can just see how big the difference is in the earnings picture of those top 7 stocks versus 493 stocks. So the 493 looks like the S&P 500. Those squiggles kind of go down, but they're growing over time from year to year, which is what the earnings growth numbers show. But the top part shows that the same thing is true for the Mag 7, but the estimates keep rising, almost week after week. And that kind of earnings momentum, I think, trumps everything else, no pun intended. So that's more important than the valuation side and the amount of, market cap weight that they consume in the markets. But it shows how important it is to keep an eye on that earnings picture, because if those numbers ever start to roll over, not by not growing sequentially year over year, but just by the estimates starting to come down instead of going up over time, that would be a major red flag that the earnings that the AI trade has extracted have been extracted, and then you just are left with a massive valuation difference which is then not supported by rising earnings estimates, right? That's kind of a long-winded way of saying it, but to me, that might be a big story for 2025 is, will that momentum continue? And if it doesn't, what happens to that space when the valuation is almost twice as high as the rest of the market?
Can that space be picked up? There's a great question coming in. Can that space be picked up by the equity story of the other 493? But also perhaps equities around the world that are in a different situation. There's a question here about Europe. The question specifically is, has investing in Europe fallen off the map? What's your take on investing in Europe?
Yeah. So Europe is an interesting story. I mean, pre-COVID, post-COVID, you look at different regions of the world, and the U.S. of course has grown very substantially, and Europe has somewhat stagnated. And it shows you the power of the story of there's too much debt everywhere, right? Europe, China, Japan, Canada, the U.S. But if you can maybe not grow out of the debt, but at least grow fast enough to kind of keep up with it, then you're the cleanest dirty shirt, right? And Europe, which is barely growing, I think the Eurozone GDP growth is like real GDP growth is like 0.8%. Um, if you're not growing fast enough and you have this massive debt burden, how do you maintain that without going through austerity or into inflation? And France is in the headline because with the elections and like the person that was in charge for a few days, the prime minister, is already getting booted because there are no good options if you have too much debt and not enough growth. And so I think this is part of the U.S. Hegemony kind of story that, especially with the election and now this red wave, that the hope is that whatever we think of the people in charge, if you get those animal spirits and you can grow, then that is still the best outcome. But if the Mag 7 do roll over and they take the market with it, then it will be very important to focus more on the relative performance than the absolute performance. So the beta versus the alpha. So the beta may not work. I mean, maybe Europe goes down less or value goes down less, or maybe they go up while large cap growth goes down. But it'll be important to have multiple pieces, multiple asset classes in the bucket so that you're not completely concentrated on the S&P 500 cap weighted. So an equal weighted strategy, maybe something down cap, maybe something outside the US, whether it's EFA or EM, those will become relative alpha generators, but it may not be in an up market if that pans out.
Okay, interesting. And then sort of a somewhat of a follow on from this is this a good reason? And the other reasons you were talking about before, is it a good reason to buy managed funds instead of an index?
I think what I just laid out, and again, we don't know.
You're not going to say no to that, are you? So,
but we don't know if and when this is going to happen, but we do know from history that these nifty 50 periods do eventually end. And so an active strategy then becomes very important because in an index fund or an ETF that mimics the S&P cap weighted index, they're going to do exactly what those Mag 7 stocks do. And an active manager, if he or she is kind of in that herd, then it may not help you, but at least that person, that portfolio manager, is able to pivot and say, you know what, I'm getting out of this space, and then you have, I think, a much better chance of capturing that alpha.
Interesting.
But again, this is all sort of academic at this point. We don't know that this might be another 5 years, right, before it happens. But we know from history that these things, the pendulum swings, and but for now the earnings momentum is very strong, and I don't see any reversals in that. But these are things we should be thinking about, as we shepherd our clients, assets around. So.
Yeah, and just that idea of growing into the valuations, which is all part of the sort of growth investing story. But yeah, what's been brought forward already on the AI trade particularly just seems to be one of the many questions that needs to be answered there.
Yeah, and when we were in at the recent event from Fidelity Canada, and Mark Schmel was on stage, at some point the momentum might pivot from the creators of the AI infrastructure to the companies who benefit from it, right? The companies who actually buy the products and see their productivity gains open up. And so, I'm not close enough to the space to know when that happens, but that would be a good reason to go out of sort of the cap weighted into the equal weighted, because then, the trickle down effect goes from these 7 stocks to everybody else, who then can create more productivity. And so there's a way that you can visualize this in a very positive way. But again, if 7 stocks are 30% of the market, then it becomes a question of, do they go down or do they just go up less than the market? And again, you get into the alpha versus the beta. But you look at the equal weighted index, the PE is 20, earnings are growing. The Fed is relatively friendly now. So there's not a lot not to like. But the question is, how do you capture that part of the trade without being at risk of the other half?
Well, as you say, you've got things shifting. There's the rate story is sort of a tailwind for mid and small cap. And then if suddenly AI becomes actually accretive to the earnings of all the other companies,
Yeah.
it's a nice setup.
Yeah, it's a setup for ongoing earnings growth, which I expect, the estimates are for 12% next year. I think that's that's attainable. And again, the average stock is not expensive. And so you got that combination should be good for this bull market to continue. I don't think we're going to get that amplifier of PE gains on top of earnings gains, but that's okay. I mean, the market can't go up 30% every year. That would be unsustainable. So
Tell us about the Fed with our 4 minutes left, 3 minutes left. So we've got this. What's the Fed got which plates are
yeah.
they?
So slide 7 shows the Fed. So the Fed's meeting next week, I guess. My sense is that the Fed is actually fairly close to being done cutting rates. So the forward curve, which is the dotted line, goes down to like 3.6. The Fed is at 4 5/8. The market is expecting the Fed to cut. Powell has been more equivocal, as he should be. But let's say they cut, we'll be at 4 3/8. My guess is 4 is neutral, right? So inflation has been somewhat sticky. Core PCs at 2.8, core CPIs at 3.3. So let's say inflation's at 3. Let's say it doesn't go any lower. Then you add 100 basis points for a natural real rate. You get to 4%. So that gives the Fed maybe 1, maybe 2 more rate cuts next year, but probably not more than that. And I think there's a risk that if the economy reaccelerates next year, as we get deregulation and animal spirits and capital formation, inflation hasn't really been completely tamed, right? I mean, if the average is 2% and we were at 9 and we're now at 3, the pendulum hasn't swung far enough to below the average of 2 to stay at the average of 2, if that makes any sense. So if the economy were to reaccelerate without the inflation genie having been put back in the bottle entirely, the risk is that that 3% becomes 3.5, and then the Fed is like, okay, now we can't cut it all. And so I think that's another potential story for the next year or two.
Fascinating. It's such an interesting time to be watching these markets. It always is, but doesn't it feel extra interesting somehow?
Yes, it does.
Jurrien Timmer.
It never leaves me looking for things to write about and charts to make because there's so much fertile ground. So
wonderful. Thank you for joining us and sharing your views. Always a delight. Have a good week. It's Jurrien Timmer joining us on Fidelity.